Well, welcome to Emergence 2021. This is the Fund Managers and Deal Makers panel. Really glad you can be with us. I'm Nadine. I'm from Ausbiz. You can find us at ausbiz.com.au. I am here with an illustrious panel, let's call it that, of fund managers and deal makers. We have Jun Bei Liu from Tribeca. We've got Chee from 8v1 Holdings. We have Niv Dagan from Peak Asset Management and Monik Kotecha from Insync Funds Management. Jun Bei, I might start with you. If you could just give our audience just a bit of an introduction to who you are and what you do.
Of course. So thank you, Nadine. And it's such a pleasure to be part of this panel. I'm a fund manager for Tribeca Investment Partners. I manage a Australian-focused share fund with the fund just over $880 million. The fund has been around for over 13 years, and then my fund is extremely active, so it offers a long-short offering and the like. So yeah, that's me.
Okay, Ken, maybe we'll go to you next. 8VI Holdings. Who are you? What are you guys interested in?
Hi, everyone. My name is Ken. I'm based in Singapore. I'm an entrepreneur. Our group itself is a fin-edutech company. We focus on educating the public on investing, especially in listed companies. We also have a financial technology division that help our user to invest smarter, faster, and easier. Now, all the cash flow we generated plow into our quant fund, where we select those companies that we find that can grow and compound on a long-term basis. So in a nutshell, we are a long-focused internal fund. Yeah, thank you.
Okay. Monik, welcome. Good to see you there. Just tell us a bit about Insync and where your interest really lies.
Yeah, hi, Nadine. Yeah, so name is Monik Kotecha. I'm the Chief Investment Officer at Insync Funds Management. We're based in Sydney. We're a specialist global equity manager, very much focused around global megatrends. So what we're seeking to do is invest in around 30 highly profitable companies that are benefiting across 16 to 17 global megatrends. So you get a good level of diversity across there. So very much a future-focused fund. As I said, focused on really strong, fast-growing, but highly profitable businesses that are really benefiting from the trends, the big trends that are coming forward.
Okay, well, can't wait to talk about megatrends. Niv, last but not least, we can call it lucky last. Tell us a bit about you and Peak.
Yeah, hi everyone. Niv Dagan from Peak Asset Management. We're a boutique investment management corporate advisory business based in Melbourne. Our whole philosophy is all about co-investment, which means we only put opportunities in front of investors, and they may be your Tribecas of the world all the way to your retail high net worth that we co-invest alongside them. We're sector agnostic, so we look at anything from artificial intelligence, machine learning to technology, mining, infrastructure. Very diligent the way we do things, and great to be here. Thanks very much.
Great. Let's just start the conversation where I think we have to right now at this time, and that is with the question of inflation. Now, inflation and expectations are being brought about right now by the prospect of a recovering economy. I mean, this is front of mind as we head more into 2021. Jun Bei, I'll start with you. I mean, there's a lot of negativity that's being talked about in terms of rising inflation, rising bond yields. But at the very base of it, considering we're at the end of a pandemic, I mean, what we want to see as investors is economic growth, right?
Oh, absolutely. I think you're touching on the very core of it. Yes, inflation is a bad word, or it always sounds like a bad word. But however, just like you said, we're only just recovering from, the sharp GDP decline or economic recession really in the last 12 months. So we want to see some level of inflation, but honestly, it hasn't come through yet. It's what we're talking about is essentially the expectations of inflation somewhere in the future. So for that kind of environment, it's actually really good for the underlying activity, economic activity, because, when people are expecting, there's a bit more activity further down the track, they will invest and then expecting higher return, a higher return in the future. So it is, at this point, it's actually really good for economic activity and really good for the equity market as well. So, we're not talking about rampant inflation. This is way off at some point.
Monik, do you agree that at this stage of the cycle, inflation expectations are indicative of growth to come in the economy? Does that type of growth, though, change how you view some of the long-term investments that you're interested in terms of themes?
Absolutely. Look, it's a great starting point because it's obviously the whole range, and there's been a shift in the landscape in terms of investors moving towards businesses that are more likely to benefit from much higher economic growth rates and inflation. So I think certainly from our perspective, you're going to see an increase in inflation when you're coming out of a recession, right? So this was obviously a government-induced recession, but that's a natural phenomenon. The key question is inflation going to be any different from what we've experienced over the last 10 to 12 years since the GFC? And really, inflation has been at around 2% for most of that period. So some level of inflation is healthy. It's only when inflation gets out of control that interest rates need to go up very significantly, and that becomes very bad for valuations and for markets in general. The two big issues we see confronting significantly high inflation is what we call the output gap. So there's a lot more capacity out there than there is demand for it. So there's, we're seeing that both in the productive capacity, and we're seeing that in the labor market as well. And that's why wages really haven't gone up for a very long period of time, even before COVID. And if you think about COVID, that actually increased the level of unemployment globally. And the other feature is that despite the fact that there's been a lot of money printing and concern that that's going to lead to rising inflation, the velocity of money, which is how quickly the money is moving through the economy, has been declining. And so really the big issue there is that the banks haven't been lending, people have been borrowing aggressively. And unless they borrow, you're not going to get more economy flowing into the economy. So our core view is that, yes, there will be some pickup in inflation because obviously it got to very low levels during COVID. But we think there's some major headwinds for it to rise significantly above where it has been over the last 10 to 12 years.
Ken, are you concerned when you speak with investors about inflation at this stage of the game? Has that colored your view, changed your view as to where you would look to invest?
Of course, I'm not an economist, so what I share is from an entrepreneur point of view and our interaction in the market with the retail investor and a certain high net worth individual. Now, our company focus on a lot of tech company that are growing very well, especially during the COVID. And companies that actually manage to transform themselves from a traditional business to actually a more technology-driven company right now. The way I actually observe is a company that use technology and growing very well. In fact, they produce deflationary effect rather than inflationary effect. Why? Because they're able to do much more with much less resources. They're able to charge, what typically about, let's say, 10 times lower of what their competitors are charging, but yet able to generate more GP, more net profit itself. So technology is changing, the new decade or the new era, how the economy is actually growing. So that to me, I don't think is actually a major concern because I feel that a lot of people actually have not spent enough time to understand the impact of this technology evolution, in the new decade itself. Yeah, that's my take.
Niv, we just need to finish off the inflation conversation with the obvious question, which is, does it really significantly change your view on what companies are worth investing in terms of technology and growth?
Yeah, so inflation, as Monik said, could actually be a positive. There's two types of inflation, obviously demand and push or cost inflation. We actually spoke to a fund manager today they think that inflation's a positive because there's obviously a pickup in asset prices. So it really comes down to interest rates and whether interest rates will actually rise anytime shortly. So, look, we believe that interest rates will remain low for an extended period. We believe that bond purchases will still be in play. We believe that the US dollar is going to continue to fall and hence commodities will rise. And I think the biggest issue facing companies right now is essentially whether they can get supply. I mean, we spoke to a company today. They manufacture biodegradable bags and nappies and using cornstarch. And essentially the biggest issue right now is actually getting access to the raw materials. So, look, I think there's a lot of issues overall facing companies in 2021, and obviously inflation's one angle, but it comes down to how inflation impacts the companies and whether it's a positive or a negative.
Okay, so go ahead, Jun.
I was just thinking that's a really good point here, because we just had the earnings season here in Australia and over in the US and globally. Now, quite a lot of corporates actually, especially over in the US, has talked to that increased cost pressure because, difficult access to, tight supply chain and difficult access to raw material and things, and, commodity prices where it is, energy prices. We're actually seeing a broad-based increase in the expectations for some of those issues that we touched on from corporates itself. So no wonder we have this rise in expectations of inflation. It is something to be watched because while as company have that power, pricing power, given consumer wants those things, and there's all these stimulus checks to come through. At which point does that break the demand? So I think so far so good, but inflation is something to be watched for sure.
Monik, I'm curious from your point of view at Insync Funds Management. So you're curious about these mega trends, these future-focused companies, where we're having so much conversation about investing in cyclicals. So investing in companies that are leveraged to the economic recovery, whether that be in the commodity space, mining, infrastructure. How does that translate into the thematics that interest you there at Insync?
Yeah, it's a great question. I think that the beauty about investing in mega trends is that, from looking at it today and looking at 5 or 10 years, they're very significant in terms of the market size they're going to grow into over time. So large addressable markets that's going to keep on growing at very high rates. They don't tend to be influenced by the economy, so they're relatively insensitive to economic cycles and to pandemics. So of the 16 mega trends we had in place, 16 or 17, we only had to sort of reduce or eliminate 1 or 2 of them because the COVID did dislocate the trend path of those 2 specific mega trends. But the other 14 mega trends were still largely in place because there was no impact. And in fact, in some instances, COVID actually accelerated some of the trends that were already in place. So we don't sit here worrying about the next year or two, what interest rates are going to do, what the cycle's going to do, because that's not our focus. Our focus is really about buying into durable trends and really finding businesses that will keep on growing regardless of what the economy is going to be doing, because they're not going to get impacted by it.
Actually, I'm curious. Quick question: what were the 2? I'm just out of curiosity. What were the 2 trends that that the COVID dislocated? I'm curious.
So I want to ask the question too.
Sorry, go on. Yeah, the first one won't probably surprise you, and that's travel. And obviously post COVID, we're moving into a different travel environment. Our experiences, when you break down GDP. Pre-COVID, at the broadest level, there was significantly more money spent by consumers on experiences than there were on durable goods. So when you looked at GDP growth, spending on experiences was growing ahead of GDP in things like travel, for example, and then investments in durable goods like fridges and cars was actually growing at below GDP. So travel was a massive mega trend for us, and we found some great companies. But clearly, COVID dislocated that. We're still very positive on it because I have this sort of feeling in the back of my mind. There's got to be massive pent up demand in travel when it starts again, and people keep talking about maybe it'd be like the 20s when we came out of the Spanish flu, that travel, it was, people will start spending like there's no tomorrow again, because there's so much pent up demand just for, just going out there and saying, well, oh my God, what have we experienced? We just need to enjoy life, basically. So anyway, travel was one. And the other one was the gig economy. There's been massive growth in the gig economy, freelancers, Uber drivers, et cetera. And we owned a company called Intuit, which is it's like Xero, but it's significantly larger. It's in the US. And as the gig economy was growing, they needed their accounts to be prepared a certain way. They needed a bit of tax to be prepared in a certain way. And Intuit was a big beneficiary of that. So with one of the biggest negative aspects of COVID has just been the damage to small businesses that occurred. The larger businesses have actually come through really well, but the small businesses have been severely impacted in a very negative way. And Intuit was a major beneficiary of the growth in the small business and the freelancing and the gig economy. So we reduced our exposure to that particular mega trend as well.
Ken?
Thank you. Yeah.
Did you have a question, Ken?
No, I don't. I do echo his sentiment. I think it's a very interesting way of actually looking at investment thesis itself. Yeah.
So where then do you see the big growth opportunities, the big sectors that will outperform, Ken? I know that you're long-term investors, so I'll say in the long term.
Well, I have about 120 team members in my organization. I'm one of the oldest. I'm currently about 40 years old. So, and on average age, my team members is about 25 to 28 years old. So when I go out and interact with them, I discover a lot of them actually game. So they have a lot of mobile games, constantly at home doing gaming. So gaming to me and streaming platform in terms of actually ByteDance and Huya, or Scale in US, or at least in US itself, whether China-based or US-based, I think it's going to be the next era of very fast grower industry itself. And we are just seeing the tip of iceberg, because in terms of actually the monthly active user, how fast they grow. And when you talk to the young people, it's just amazing how much time they're spending there, not only gaming, but watching other people how to game. That is the very interesting behavior, for me, right? So I can't understand why, but now I know why. So gaming for me definitely is one of the industry we're looking at, and I think it's poised to actually grow at a very high teens multiple, at least for the next 5 years. Yeah.
Well, Niv, this is the thing. You don't have to necessarily understand or do it yourself when it comes to some of these themes that you think are investable ideas. So, Niv, when we've talked about these mega trends, talk about growth coming through in the future, where are you looking as we continue to see these economies around the world really recover from the pandemic?
Yeah, it's a good question. I mean, as Ken said, gaming's interesting. I mean, we actually backed a company called iCandy Interactive. They're a mobile game publisher. They've got 5 mobile games. They've actually just done a joint venture with ByteDance and Alibaba as a shareholder, but they've also got an esports division. It's quite incredible seeing the sub 20-year-olds watching other people's, packing stadiums in 40, 50,000 people watching others play. Games. It's quite mind-blowing, but it's a sport, right? There's a lot of money coming into gaming. The other sector, obviously, and I do agree with Monik, is travel. There is a lot of pepped up demand. Domestic travel, obviously, is booming. Airbnb and Uber and a lot of travel, but it's overseas. The really question becomes, what happens overseas when the markets do open and travel does become the norm, and then you've got experiences, travel, camper vans. So I think travel's interesting. I think gaming's interesting. The other sector that we're looking at is what's happening in electrical vehicles. So, there's companies out there that are building gigawatts, multi-billion-dollar investment in OPEX and CAPEX in terms of to support the iron batteries and obviously the lithium batteries in electrical vehicles. And we've seen the growth in Tesla. And the new theme or the new buzzword is hydrogen. And it's all about green hydrogen, which is essentially not using coal and not using, obviously fossil fuels and going to zero emissions. And that whole theme is just getting huge traction. Now, there's a lot of, how do I say it, not saying fake companies, but those companies will just never make it. And I think with the issue with hydrogen and some of these themes is that you need to look at the OPEX and CAPEX of some of these companies and see, do they have the balance sheet to actually build a $500 million gigawatt factory? I mean, do they have a partner such as Woodside or Fortescue or BHP alongside with them that can actually help open doors and help transport the pipe and gas, et cetera? So I think investors really need to be careful in some of these themes, and it's all about, once again, backing the right horse, but it's also all about backing the right management and having the right partner.
Well, just sticking with that, Niv, then, I mean, isn't that where the corporate advisory side of things come in, and where private capital, private investment opportunities come in as well? I mean, there's still a lot of cash that is sitting on the sidelines looking for these opportunities.
Huge amount of cash. We actually caught up, just before Christmas with a client of ours. He's very high up in the National Australia Bank, and he said there's over $370 billion in cash in people's bank accounts, earning pretty much 0% interest. So if you're looking at asset classes, obviously, you look at that high growth, which is domestic or overseas equities or ETFs or IPOs or venture debt. There's a lot of opportunities, but investors do need to be cautious, and you do need to obviously do your due diligence and back the right team with ownership and due diligence, absolutely. And those people, I'm not saying like us, but those that are on the panel that really have a skill set to execute and put skin in the game, I think that's important.
Jun Bei, Niv mentioned IPOs there. It's been rich out there for IPOs. What are you feeling as we head further into 2021? Do you think that there are some companies that are coming to market that maybe are picking this opportune time? How should investors separate the wheat from the chaff?
Look, absolutely. I think IPO has been, reasonably successful over the last little while, as with many equity raisings. Now, of course, I think we still have a good pipeline that's coming through. Generally, they start at about March because reporting season is now. Once reporting season's over, we start hearing from companies and they start doing roadshows. So my view is that there's a couple on the go in the next few months, and we'll see more of it as it builds. Now, market conditions really good for IPO because the market just going from strength to strength. So far, this calendar year, we're already up 4% here in Australia. So it's a very strong market condition. Now, what stock is going to do better and what sectors those IPOs should be in, it really depends on the flavor. Now, this year, as we talked on before, the big theme is, back to work, which include all those travel businesses, property, offices and shopping centers, some of those names. These companies will do well as their earning return to normal. And, perhaps sectors such as reflation, which we talked to, the inflationary companies that benefit from high inflation. So, IPOs or capital raising in the mining and resources space should do reasonably well. So I think there's a good pipeline coming through, and certainly there's a lot of demand for it. Now, I think Niv touched on before about, investor demand. There's a lot of cash sitting on the sideline. Absolutely. And just a piece of news I saw last week is very interesting. Chinese government's now looking at allowing Chinese investors to be able to invest offshore, in offshore shares, which is going to be incredible. I'm sure everyone knows that China share market is I think it's more than 90% dominated by retail investors, and the retail flow just being enormous. So, once that happens, all your high growth and sexy stocks will start going higher. We just saw all these retail investors pushing up or some of those highly shorted names a few weeks ago. Imagine all the Chinese investor coming in, imagine where their share price might go. So, certainly there's a lot of cash and demand for deals, for IPOs, but quality companies clearly, and need to be in the right sector. I must say, with the current high inflation expectations and things, there is a little bit of profit taking, say in some of those growth names. But for long-term investors, this does provide pretty good buying opportunity for some of those growth leaders. But just in the short term, we should. I expect us not to see too many line up in that whole tech growthy space at this point.
Yeah, Ken, are you looking for opportunities in that when you see companies being sold down in this environment?
Of course, but before even I actually share that, I actually have a question for the panel here, because I think in 2020 in US there's a increased interest on SPAC, because since we are on IPO, right? So a lot of tech company right now going through special purpose acquisition vehicles for coming to the market. So what's your opinion on that? Yeah.
Yeah, look, it's interesting. Look, I don't know. I'm actually on a group, on a WhatsApp group. There's about 250 corporate advisors and boutique fund managers on it. And some of them are US guys, right? And it's really interesting. I mean, SPACs, it's not necessarily new, but we're seeing so much growth in SPACs relative to IPOs, and whether that's the ease or the lower cost or just the type of companies. I mean, my preference is still the IPOs and the traditionally, but it seems like the New York bankers do like the SPACs, whether it's easier to get a deal done or whether they get higher fees. I'm not too sure. But, for those that are listening at home, a SPAC is essentially a vehicle, like a reverse takeover, to list on the exchange, right? And it might be a quicker process than at a traditional IPO on the NASDAQ. So interesting theme, but yeah, not sure, Monik and Jun Bei, what your thoughts are.
Yeah, I think you make a good point. Absolutely, it is easier and faster and the like. It also offers the retail investors an access to some of those early stage businesses. So it does serve a purpose, and that's why it's been incredibly popular. But now the prices and all of that, it's going to be volatile. That's face it, because it depends on the investment cycle, depends on who's doing it, because quite frankly, quite a lot of those it's really just, you don't even know what's in there, you're just backing who's doing it, right? So ultimately it is the team that does it, so just have to be very careful with who you're following, and I think some of those transparency is going to be quite important to to ensure the long-term success of that vehicle.
Monik, would you be tempted by a SPAC?
No, look, I mean, our focus is, I think, as Niv mentioned, there's a lot of cash sitting not only here but overseas. I mean, it's just incredible the amount of cash sitting in bank accounts earning zero. So there's a desperate search for returns. And traditional defensive assets are now providing a very low return. So everyone's being forced to go up the risk curve. So everyone's now chasing everything out there, be it an IPO or a SPAC, and these are now showing signs of exuberance in bubble type behavior in certain parts of the market. And I would say the IPO and SPAC market will be symptomatic of that today. So one has to be careful. There will be some jewels sitting within that, but I think you have to be very discerning. From our perspective, I think because there is so much cash out there, a lot of businesses are now able to raise capital much more easily than they have in the past. So if you invest in an early stage industry, for example, that is still developing, there's no obvious winners. No one's really making any profits. Sure, they're growing their revenues. Because of the easy access to capital, it's bringing in a lot more competition. So whilst the good times are here and everyone's throwing money and everything seems to be going up and the party's on, everything seems very, very easy. But as time goes on, you'll find that a lot of these companies will actually end up falling over and failing. And over time, you'll end up with one or two or three industry winners. And it's at that point that we like to get involved, because really for us, mega trends are very long term. And so we don't want to be there very early on, because it's really difficult to work out how exactly the mega trend is going to form and who the winners are going to be. But the one thing we know about mega trends is they're very enduring. So even if you take something like the cashless society, it seems like a boring stock today, but even something like Visa and now PayPal, they seem very boring compared to the upstarts today. But, if you invested in PayPal when it was spun out of eBay, you would have still made pretty close to 5 times your money, because the penetration of e-commerce is still very, very low. So there's a massive runway of growth, but PayPal is an incredibly profitable company. So we like to get involved when there's still an enduring trend, when the trends are accelerating, and we can identify clear winners. And so we think that's a better part of the market to participate in.
Actually, just to echo your point, I think you're right. There's a lot of demand for asset price for any assets, and the cash clearly will come into the market. But just in terms of the listed share market, there are so many opportunities at this point because of the economic backdrop. So last year, 6 months ago, it was all about tech. It was all about growth. We talked to all these exciting growth and things. So there was a lot of cash going after it. Now, then you have to take on more and more risk because you're paying for more and more for those companies because there's very limited number of them, especially here in Australia. But today, because of the economic recovery, you're seeing so many more opportunities in those old boring businesses that's been around for ages. And you're looking at double-digit return within a few weeks once you actually identify the right businesses. Just one example, Bank of Queensland. Who would have thought this is a company that can deliver 30% return just in the last few weeks? And even if you look at ANZ or some of the big banks, the return actually has been very, very meaningful for a short space of time, and for the level of risk you take for them. So if you annualize that kind of return, that's just been incredible. And you're not actually competing with many other people for some hot asset that you're paying, significant amount of value for. So I think the current market environment for the equity listed share market is that just as investors, if you're discerning and be very firm about what you're buying, and you can just find opportunities everywhere, whether it's growth company being sold off or whether it's a value company. So it's a great environment.
I can sense your enthusiasm for the environment right now, Jun Bei. Ken, where are you seeing opportunities? Now, I know you mentioned the thematic of esports and gaming you like, but are you seeing any opportunities throw themselves up because we're seeing some of this rotation out of those high growth names into more value, which is your business, value end of the market?
So our portfolio allocation is mainly on two main markets, China and US, for a very simple reason, because we feel that this is a two very dominant economy going forward, at least for the next 5 to 10 years, until they have to wrestle it out and actually decide who's the winner. Okay. However, in China company itself, we are looking for category leader. So not necessarily in the tech, the panelists have said, we can look at very boring business. I give example. One company we actually have a very heavy weightage is actually Guizhou Maotai, which is it's a very well-known so-called baijiu. That means it's an alcohol product, but it's a national brand in China. Look at the GP, look at actually operating margin, look at the net profit margin, look at the free cash flow. These guys is just amazing. Over the last 10 to 11 years, they've increased their dividend from actually $1.70 all the way to $17, which is a 10 times increase in the dividend payout itself. So, and over the last, I think easily 10 years, we're looking at a return of about 2,200%. So we got in during the US-China trade war in end of 2018 when US Donald Trump, the former president, fired the first so-called silo in attacking the China in using the trade war. And a lot of fund was pulling out from China back to US, and the Guizhou Maotai share was back then grossly undervalued. So we went in the big way and anchored ourselves in a good stake because we have been watching this company for a good period of time, but it's always overvalued. But when opportunity and crisis hit like that, okay, we will actually take a lion buy. So in China, we're looking at actually category leader. So on a day-to-day basis, okay, not necessarily high-tech company. Why? Because China is moving from what we call very rapid urbanization, where we are going to see a huge, I believe will be about 600 to 800 middle-class family, right? Middle-class population, 6 to 800 million. That is more than Japan and US combined together. And in fact, maybe I add in Germany. So from that point of view, you can see the spending power of this economy. And when the population has more spending power, okay, they are willing to spend, okay, quality stuff, okay, and they're able to pay premium, prices for good stuff in China. So this is my take for China itself. For US, we also have a very meaningful stake in a company called ETSY. It's an e-commerce company cater to a woman. It's a niche. They are the third largest e-commerce visited website after Amazon and I believe it's eBay. Yeah. So why? Because first, because they are very focused. It's in a niche market. Okay. And during COVID hit, okay, their business model panicked, and you can see in terms of their revenue, operation cash flow, and free cash flow, it's just amazing. One key thing is we look for operating leverage. We look for company that are able to demonstrate, okay, when they grow their revenue, their operating income before EBITDA itself increase much more, right? So that is a sign of a very strong business model and a sign of what we call efficient use of their capital itself. Yeah.
Yeah, so Niv, there's a lot in that, but I mean, sometimes is it best to not go for sexy? I mean, we talk balance sheets, we talk operating leverage, the metrics behind these investments. How important to you is that? Well, always, but also particularly at the point that we are in the cycle, to Monik's point, we are seeing some signs of exuberance.
Yeah, it's a good question. I think right now there's just so much interest in your high growth stocks, and if you're not sexy, it's not worth pursuing. And I'll give you an example. One of our portfolio companies is a company called Beam Communications, which is BCC. It's a sub 20 million market cap. It's doing about $20 million of cash receipts. So it's trading at one time its historical revenue. It's profitable, $3 million of EBITDA. It's in the telecommunications space. So essentially what they've got is a little device. So think about Ken or Monik, if you were hiking somewhere in Himalayas and you're stuck in a mountain, essentially got a little gadget called the Zolio, which is half the size of your iPhone, and it's got two-way remote messaging, GPS tracking, weather, connected to a $5 billion network, a satellite network called Iridium. Now, great business, profitable, growing, strong management, big cash flows, great partnerships, but the market just, it's going up. It's up 20 or 30% since our placement, but if you compare it to, a little silver explorer or a hydrogen company that says that instead of drilling for oil and gas, they're drilling for hydrogen in Alaska, it's an interesting thematic right now. So there's so much money. There's a lot of retail money. I think the social networks in terms of the Twitters of the world and the Facebooks are really changing. And we saw that with Reddit and the Wall Street and GameStop and everyone at home watching. It's just an incredible saga of what's occurred. And there's no doubt it's going to be some sort of a Hollywood blockbuster in the next 12 to 18 months. But there's a lot of retail money on the sidelines, as I mentioned before. And those traditional, boring companies, whether it is the banks or the Visas or the Beam Communications, are great. The 20 or 30% annualized returns, that's incredible. But I think the market is looking for more. It's just there's a lot of greed. It's incredible what's happening now because 20, 30% returns, the market's looking for more. It's interesting.
Yeah, but I think the tough thing is that, yes, there's a lot of people searching for those growth. And I think it's actually so typical of Australia is that we have very limited opportunity set. So, companies listed or growth companies listed in Australia tend to trade at a premium compared to its US or global or Asia peers, actually, for far less growth compared to some of the Asian peers, all because we have so much retail money and institutional money chasing after very few names. But in the last few years, we have seen them, growing quite substantially and significantly. So it does mean that, it can become quite volatile. For something to double overnight or double over a period of time just means that it can halve very quickly if it's just full of hot money. So it's incredibly important for, for investors to really know the company, know what you're paying for. If you're happy to pay for however many times revenue, some of them are not profitable, some of them are. So it's actually incredible, intricate time that, do your due diligence, find the company you want and just wait for that price to get to you because it will.
Well, I wanted to add on to these 2 points. I think both of you make very valid points. So I want to highlight here this is my own experience because we are a listed company, we listed in Australia Stock Exchange. So, and we used to run a traditional education business. And when 4 years ago, we decided to do digitization. So, and we went through a very tough period of actually executing our strategy. But we managed to build our technology team. And in 2018, we launched our financial technology service for our user. So now what happened here is during COVID, the strategy pay off. So because everything is locked down, we can't interact with our customer. But because we have digital platform itself, our revenue it actually went up by fourfold, right? Our cash flow, operation cash flow went up by, in fact, close to eightfold. So free cash flow, net profit, everything improved. So now, and we come from a very nano cap company, and then over a 1 year period, our market cap have grown by actually, I believe, is at least close to 1,000% return for our shareholder. So my point here is not to promote our company share in ASX. My point here is there is opportunity in even Australian stock market to look at small, medium company. They are actually going through transformation. There's no debt, okay, and they are able to scale this business because of COVID using technology. And that will give you a tremendous return on your portfolio, even you put a very small amount in it, right? So as compared to everybody chasing after the brand name and you have to pay a premium for it. So this is where I want to come from. Yeah.
All right, Ken. Now we could talk for much longer, but before we go, I'd just like to ask each of you a specific question. So I'll start with you, Monik. Talk to us about the mega trend that is front of mind for you right now as we move further into 2021, given all that we've just discussed.
Wow. Well, we're pretty excited across all our mega trends. I mean, we've got 16 mega trends and all of them are, give or take, pretty similar in size. So it's not like we're over enamored with one mega trend. What I would say is you don't have to be fixated with technology. I think in this period of exuberance, it's more about compound returns than looking for 1 year returns. Okay, so if you can find businesses that are highly profitable, we use return on invested capital. It's not net margin, it's the amount that's been invested in the business and the total return the company generates. So we look for the highest returning businesses, and we find many outside of technology. So we do like some of the technology space. Yes, we've got cloud computing, we got gaming. We are excited. It's actually, gaming is now larger than the movie and the music industry combined. Okay, so I'm talking about streaming. Cinemas are dead now for the time being, but they're coming back. So that's how big gaming is, and it keeps on growing. So we are excited, but we're excited about the beauty industry. I mean, that's a $500 billion industry that's growing, particularly at the prestige level, at 2 to 3 times GDP. And there's only 2 or 3 players, okay? And we own Estee Lauder, which is a very high returning businesses. It's most of its sales are now coming through e-commerce. China is 60% e-commerce penetrated. The rest of the world is moving in that direction. L'Oreal just came out and just said, we're seeing sales like it's the roaring 20s, okay? We're invested in the pet industry. We think pets are increasingly being treated like humans. That business is growing at high single digits. In fact, pet spend accelerated during COVID. And pets are now increasingly being treated like humans. Surveys have shown that 80% of people consider a pet to be part of their family. And again, you can find wonderful businesses. We own Zoetis, which is the leading provider of vaccinations and medications to the pet industry. It's a dominant player, high margins. But again, it's the compounding. We can see years and years and years of growth ahead because the Gen Z are the first younger cohort that are treating pets like humans. And all their surveys are saying that they're happy to spend more than any other generation. So if you look at the demographic shifts ahead, as they get older and they're already spending a lot on pets, that trend is going to continue. So I think it's all about finding high quality compound businesses that have these long-term mega trends, and you can diversify away from technology. There's lots of other areas to invest in.
Niv, we often complain here in Australia about our market being so leveraged to the miners and to the banks. Are you excited, though, by some of the emerging companies that you see here that are looking to list or are listed, but just, small?
Yeah, look, I mean, there's a lot of themes overall. I mean, banking, the whole neobank or the digital banks. I mean, essentially, it's interesting utilizing fintech, utilizing AI, artificial intelligence, machine learning, detecting sort of your behaviors and your spending patterns and budgets. I mean, there's so many little sort of gadgets out there. I think traditional banks will still do well. I mean, I think bricks and mortar, probably not so, but if you are digital and we are seeing a big shift online and e-commerce. I think that's a really, really big theme, and that theme will continue. I think mining, iron ore is here to stay. Sure, we've seen copper prices at nearly 5-year highs. The price of cobalt for electrical vehicles, for batteries. I think there's still a lot of money in mining, and especially if you believe that interest rates are going to remain low when the US dollar remained under pressure, and you've seen Bitcoin and cryptocurrency as a form of a hedge against inflation. And look, we think that commodities are here to stay. So commodities demand will still be strong. Banking and fintechs will still be strong. I think the other big focal point is food, plant-based food. And the millennials, if you speak to a millennial, as in those that are sub 25, they're a lot more conscious about the environment. It's not necessarily less eating meat or being vegetarian. It's really about that focal point about plant-based and things that are positive for the environment in terms of less emissions and essentially more biodegradable products. So I think that's really big themes. I think we can go on about the mega trends, whether it is hydrogen, whether it is digital, whether it is fintechs, whether it is e-commerce. You just have to back the right team and the right management. That's the key.
Ken, how much is management a focus for you when you're looking to invest in companies for the long term?
A lot, especially in terms of the experience of the management and their core team, how they're able to execute those plans is very important for us to actually as the evaluation criteria itself. Yeah, a lot, because it will make or break the company in the short term or mid term itself. Yeah, having the wrong CEO can destroy the company. Okay, this comes from a very painful learning experience that we have. So I say a lot. Yeah.
Coming from an entrepreneur's experience, of course.
Yes.
Jun Bei, when we talk about the opportunities still to come in 2021, but beyond, to everybody's point, we're not thinking about what's going to be, trade in the next weeks, couple months, year. Where are you really seeing the opportunity? Your excitement is palpable. Do you need to be agnostic across more traditional versus more, innovative names?
Look, my view has always been, if there's money to be made, you go for it. Don't, wrap yourself in whether growth or value or any of that. If there's money to be made, we're there. So I think in this sort of environment, I am absolutely, looking for opportunity in the growth leaders. We like the buy now, pay later space, but they have done very, very well. And if there's any pullback, we may go back in. So there's a lot of those growth leaders may well experience a bit of pullback, and that's when you do step in and buy more of them. But across some of those cyclical and cheaper value names, if they can make 20-30% in a few months, I may well take it, and then make sure you're practical about how you be tactical about your short-term return, offset that by some strategic positioning, because you never know when the next catalyst will be, and you never know what tomorrow might look like. So all you can do is find the best quality company, best management, incredibly important, because it's the people that make it happen, people that build the culture, and people make the dream come true. So, good management, good business model, a real reason for they to exist, something that's difficult for competitor to replicate, find those businesses. And when the share price does come back, just step in and buy them. Don't worry about when will be the date that other people may start paying more for it, because it will come. For those businesses, there will always be buyers stepping in.
Well, listen, I was going to ask about risks on the horizon, but I think it's better to end on that positive note where investors can be inspired and go out and look for these opportunities and thematics that really look to pay off in the long term. A huge thanks to our panel, Jun Bei Liu from Tribeca Investments, Chee from 8VI Holdings. We've also had Monik Kotecha, Chief Investment Officer at Insync Funds Management, and Niv Dagan from Peak Asset Management. Thank you for participating in Emergence 2021. And we hope to speak soon.
Great. Thank you.
Thank you.
Guys.
Bye.